So you said in there something to the effect of the best time to invest is when you have the money to invest, right? And we've actually had a bunch of questions just in the first 15, 20 minutes here about dollar cost averaging versus lump sum investing. And
hmm
I think there might be a mathematical answer and there might be a whatever lets you sleep well at night answer, but I'd be curious to hear your thoughts and how you advise people who are going at this for maybe the first time and they don't know what they should do.
Well, so you're right. There's a mathematical answer and there's a psychological answer, and I'm a little bit hard nosed on those two things. I should say up front, because if you're choosing between them, if you choose to do what's comfortable psychologically, you are just comforting yourself. You're not doing what's best from an investment point of view. So I very much defer to the whatever the mathematical answer is. You should adjust in my world, you should adjust your psychology to the math, not the math to your psychology. So having said that, the market goes up 75% of the time and it goes down about 25% of the time. Another way to say that is it goes up 3 out of 4 years, goes down 1 year out of four. Of course, you can't predict. It doesn't do that on a regular basis. It doesn't march up reliably three and then drop one. But on average, that's what it does. So if you're sitting on a lump sum of money and you're deciding whether or not to invest it now or to dollar cost average it, what you're really betting on is the market going to go up from here or down from here?
hmm
And history tells us there is a 75% chance that it's going to go up. And it seems to me that that is always the right bet to take. It's not always the bet that's going to turn out. 25% of the time it'll be the wrong bet, but you don't know what the future holds. And therefore, the logical mathematical thing to do is to invest now because you have a 75% chance of that winning. The other thing that I would point out to people is that let's suppose you decide to dollar cost average because you don't want to take that chance that it's going to go down. And that would be a scary, terrible thing. I get that psychology, but remember, I recommend we defer to the math. But let's suppose you're going to make yourself psychologically comfortable. You have $120,000 to invest. You decide to put it in at $10,000 a month over the next year. Well, if the market goes up, you'll lose money because every month you'll be spending more for those shares. You'll get fewer shares for your money. If the market's flat, you'll lose money because your money won't have been working for you as long. The only way you win is if the market goes down. Well, let's, for the sake of argument, assume that it's flat and you get invested and no harm done or no major harm done. And you put in that last $10,000 and you send in that check or it goes electronically. And the next day, the market drops 30%. So dollar cost averaging doesn't really protect you from the thing you're trying to protect yourself from. Another way to think about it, and one of my blog readers pointed this out in a comment, is if you have that $120,000 invested, however you got it invested, every day you're essentially saying, I'm going to choose to keep it invested rather than pull it out and begin to dollar cost average it back again. Now, to be clear, we are talking about investing a lump sum. When you're like my daughter and you're investing on a regular monthly basis from your income, from your cash flow, from your job income, that's dollar cost averaging in a sense, but it's unavoidable. That's the only way that you can do it. And if you set it up and automate it, then the fluctuations in the market work in your favor. But investing in a lump sum doesn't work in your favor unless you happen to get lucky enough to invest at the beginning of a drop. And you've got a 25% chance of winning that bet. So
That's
JL.
funny.
Oh, I'm sorry. So in terms of that, may I ask you, because the way I keep myself invested and keep continuing to invest is looking at my investment policy statement or my investment philosophy statement. Would you mind sharing yours do you have one? Do you use that? Because I look at DCA as a tool that helps me stay on track for that.
right. I don't have an investment statement. I've heard of them and I suspect it's probably a good idea. Again, things are pretty simple in my life. I want my money working as hard as possible all the time. So I want it in as much of it as possible, invested as often as possible. So I
Mm.
guess that would be my investment philosophy or statement.
Yeah, and I like the phrase that you used before about it being the right bet. And it's interesting because Tommy actually put a comment in here. I know Tommy's
Yeah.
a poker player. He said lump sum is pocket aces, dollar cost averaging, pocket twos. 80% of the time aces wins. Which hand do you want? And I would extend that to say, if you were to play that hand 20,000 times, you would pick aces 20,000 out of 20,000 because you're going over the long run, you're going to win. To your point, there are going to be instances, and I guess you're saying 1 out of 4 years is down, but there are going to be anecdotal instances of it going down clearly, but the right decision over the long run in your estimation here is the lump sum investing. And that's what the math says, right?
Well, I was going to say it's not in my estimation.
Right. No,
That's
I know.
That's what the math says. That's not just J.L. Collins
No, of
giving
course,
an opinion.
of course.
Right.
And now, having said that, let me sort of argue against myself and go to the psychological side. So I said at the beginning that I believe you should adjust your psychology to the math, not the other way around. But the question legitimately can come up is, well, what if I can't do that? I mean, what if the idea of putting my lump sum in today and the possibility of there being a market crash tomorrow is just more than I can psychologically bear? Well, if dollar cost averaging is the only way for you to comfortably get in the market and you want to be in the market, then by all means, dollar cost average into the market. Understand that you're not doing the mathematically optimal thing, but at least you're getting yourself invested. Now, I have to add a caveat to that real quick, that the only way you should ever invest in stocks, following my advice or anybody else saying to invest in stocks, is if you know you are not going to panic and sell when the market plunges. Because if you do, then following my advice will leave you bleeding by the side of the road. It is very much contingent on staying the course. You need to strap yourself to the mast, as who was it? Ulysses, I think, was the one who strapped himself to the mast to keep from being drawn on the rocks by the sirens. And of course, the sirens are the news media going nuts, telling you this time is different and the end is here. So you got to strap yourself to the mast and stay the course.
I like
And if
that.
you're not, and if you don't think you're able to do that, then you don't want to be in stocks.
I